International financial markets are global marketplaces for trading financial instruments such as currencies, bonds, equities, and derivatives. They play a crucial role in facilitating international trade and investment, providing diversification opportunities and managing global financial risks. Key components include foreign exchange markets, international bond markets, international equity markets, and derivatives markets. The foreign exchange market, Forex, is where currencies are traded. It facilitates currency conversion for international trade and investment and provides hedging against currency risk. Participants include banks, central banks, corporations, investment firms, hedge funds, and retail investors. Major currency pairs include EUR-USD, USD-JPY, GBP-USD, and USD-CHF. To calculate the amount received in a foreign currency when exchanging a specific amount, identify the exchange rate between the two currencies and multiply the amount to be exchanged by the exchange rate. This example demonstrates how to convert USD to EUR using a given exchange rate. International bond markets are where bonds issued by foreign governments and corporations are traded. Types of bonds include foreign bonds, Eurobonds, and global bonds. Benefits of investing in international bonds include diversification, higher yields, and access to different interest rate environments. However, risks such as currency risk, political risk, and credit risk must be considered. To evaluate an international bond investment, determine the bond's coupon payment, face value, and yield to maturity, YTM. Calculate the bond's price in foreign currency using the bond pricing formula, then convert it to the home currency using the exchange rate. This example demonstrates how to assess the potential return on an international bond investment. International equity markets are where shares of foreign companies are traded. Benefits of investing in international equities include diversification, access to growth opportunities in different regions, and potential for higher returns. However, risks such as currency risk, political risk, regulatory risk, and market volatility must be considered. To analyze an international equity investment, calculate the stock's return in the foreign currency and then convert the return to the home currency using the exchange rate. This example demonstrates how to assess the performance of an international equity investment. International derivatives markets are where derivatives contracts based on foreign assets are traded. Types include currency futures and options, interest rate swaps, and cross-border equity derivatives. These instruments are used for hedging, speculation, and arbitrage. However, they come with risks such as leverage risk, counterparty risk, and market risk. To hedge against adverse currency movements using currency futures, determine the amount to hedge and the futures contract specifications. Calculate the number of contracts needed and assess the effectiveness of the hedge. This example demonstrates how to use currency futures for hedging. International financial markets encompass foreign exchange markets, international bond markets, international equity markets, and international derivatives markets. They facilitate currency conversion, provide opportunities for diversification and higher yields, access growth opportunities, and offer instruments for hedging, speculation,